Are we in? Okay. Hello, everybody. I'm giving everybody just a second to filter in here and we'll get started. All right. Well, I will start by saying hello, everybody, and welcome to the Build Track. This is our first dedicated session in the Build Track, and we are so happy to have you here and in this one today. My name is Kim. I am a fractional marketer and a lettuce customer myself. So when I say the stuff that we're going to cover today matters, I feel it personally. I've been there because here's the thing. Most solopreneurs don't get into financial trouble because of one big mistake. It's a dozen small ones. It's the wrong entity structure, expenses that weren't tracked. It's tax implications that you didn't notice until it was too late. And I've been there with all of it. Lettuce is building the Solo HQ so you don't have to figure it out alone. Lettuce sets up your S-Corp, handle your payroll, keep your books clean, gives you access to healthcare and retirement accounts. It's the kind of benefits that used to be reserved for people with full HR teams behind them. And now solos get the same advantages. So if you haven't looked at what this can mean for your business, now is the time, and Diane will tell you even more about it. But before we get started, let me just do a little bit of housekeeping. Okay, so please, questions, we love them. Drop your questions in the Q&A. There's a chat and a Q&A. We'd love to keep questions in the Q&A as much as possible. Keep them in there. If you love someone else's question, gives it a thumbs up. We'll make sure we answer them as we go. And Diane has been kind enough to, at the end of the session, if there are additional questions, she's going to answer them all. And so all questions will get answered. So put them in, we love them. If you haven't already started your day by networking, check out the networking in between sessions to connect with other attendees. You can also drop your LinkedIn here and where you're from. You never know, your next great connection may be in this room and at this summit. Please don't forget to follow Lettuce on LinkedIn and Instagram. Stay in the loop after today. This is just one of the many learning opportunities and experiences we have coming from the brand. And then last but not least, check out the offer section. So on the right-hand side where the chat is, you'll see handouts. And within handouts, there's an offer section. And there's a lot of goodies in there, including from Lettuce. If you're not a member yet, you have the opportunity to sign up before May to get your first month free with code SummitVIP. The details and links are in there. And if you are a Lettuce customer, thank you so much for being here and continuing the journey with us. There's an offer for you to refer a friend to Lettuce, and you both get a month free with more links and details in the chat. So that is enough for me today. Let me quickly introduce Diane, our speaker. She has more than 30 years helping business owners keep more of what they earn. Diane Kennedy is a CPA, a best-selling author, and a strategic tax consultant. She founded U.S. Tax Aid and the Kennedy Tax Strategy Lab, and she's one of the most trusted voices in the solopreneur world on building financial foundation that actually holds up over time. Some of you may remember her from our last Solo Summit, where she joined a panel that became one of our most engaged sessions of the day. The tax questions kept pouring in after, and so we knew we had to bring her back and give those questions the full attention they deserve. So now Diane gets the room all to herself today. Please welcome Diane Kennedy. Diane, I will stop talking. Over to you.
Thank you, Kim, and thank you all for joining me here today. It's exciting when I meet people that are so engaged about talking about their future with their businesses. And what we're doing today is a little different spin. It's not so much about how you can write things off, but it's decisions that you're making in the very first years. The 2 or 3 years in, you're busy, you've got a lot of things going on, and you might make some decisions that'll end up costing you a lot down the line. And when I say cost you a lot, that's money, time, and emotional drama. Nobody has time for that. So let's talk about 7 decisions that I see people making kind of by default that can really cost them later. And of course, it all has to do with taxes. So with that, by the way, please give me your questions at the Q&A. The way we're working this is that I'm going to stop as I can to pick up questions, but we are going to capture all the questions. And when you go to the offer that I have for today, which is a guide that goes along with the 7 items that I've talked about and has checklists, so you can make the right decision on those 7 questions, that you're going to want to download that and maybe listen to the session again. But when you do that, I'll get your email and I will send you the list of questions with answers from the session that I wasn't able to answer, or even ones that I did and I want to expand on. So please make sure you go to offer, and meanwhile, drop your questions in the Q&A. Okay, so the first one is a problem that seems like it's kind of simple. And it's one of these things that people, when they first get going with their business, they don't have time to deal with. And what they do is just mix their personal and business accounts together. So what they might do is they have their business income coming into a personal account, or maybe they're paying business expenses out of their personal account, or it's just all a mess. The easiest thing you can do right from the start is making sure you have a separate business account, bank account, a checking account. I also recommend you get a credit card just for your business. And I realize that in the beginning, you might not be able to get a credit card in the business's name. That's fine. Just say that this particular card is going to be used only for business. So let's say MasterCard is just for your business, Visa is your personal, or whatever. It doesn't matter. Just keep them separate. When you put them together, that's called co-mingling. And you actually can create an issue where if the worst happens and you get sued, suddenly your personal assets can be at risk as well, because you've commingled in those income and those expense items. But let me tell you a story. This is a true one that happened this last year. I had a client who absolutely did not want to set up a business account for his new business venture. And we're talking a big venture. He invested a lot of money in it, and it was high risk. So it was something we needed to really consider about liability, but he didn't want to set up the separate bank account. So he had it all together. And what he did is then created this massive spreadsheet where he divided up all of his expenses. And some of it went to his home, some of it went for some investments, some of it went into his business. And he was the one who decided what went where. But as we're going through it, one of his line items for his business was a bed. Now, his business had nothing to do with a bed, and this wasn't like a day bed for his home office. It was just like a queen size bed. Well, I had to ask him about that because it wasn't a deduction. What happened is, because he didn't have that separate, he ended up putting some personal expenses in his business. And I bet anything, there were some business expenses that ended up in the personal account, which meant that he didn't have good tracking on those. So the simplest thing to do right at the jump is set up a business bank account. Even if you're just getting going and you're not even sure that you're not ready yet with your LLC, just get it set up. The bank will help you once you have your LLC set up, either change it or help you with a new account. But get that set up so you can begin to separate those entities, your business from your personal. The second one is delaying your bookkeeping. And I've got to say, this is the thing. Unless you're an accountant, nobody loves bookkeeping. So you just put it off. I'll deal with it later. I'll deal with it over tax time. That's one of the benefits of having a source like Lettuce that helps you get your bookkeeping up to date and help you keep it. But when you delay it, you end up delaying your deductions. You delay your tax planning. You delay knowing what you should pay in estimated taxes. You really have no picture of where your business is. And as a saying I often have is, a delayed deduction is a missed deduction. Guaranteed, if you're waiting until tax time to figure out how much money your business made, you're going to miss deductions. You won't remember them. And it's a tendency we have is, if I can't really remember, maybe I shouldn't take that deduction, and you'll end up paying more taxes. In general, you've got to figure out what that is. But there's even another reason. A lot of my clients are starting to be concerned about retirement accounts. You want to put some money in an IRA or maybe a Roth IRA. I didn't have books for this particular client until August of the year after. So we're talking August 2025 for 2024. And one of the things he wanted to remind me of is, hey, I put money in my IRA, or I'm sorry, in my Roth IRA. But by the time we got done with figuring out his books, because he had a sole proprietorship and not an LLC taxed as an S-Corp, the only way we could calculate how much he could put in a Roth had to do with the income from that particular entity. And we didn't know what it was until way after the year was passed. Turns out he didn't have any income. It was a loss. That meant he had to claw back all that Roth IRA. We're talking a lot of paperwork, and he was unhappy because he had a plan for building up a Roth IRA for the future, which was a great plan, but he didn't have the bookkeeping to support that. That's one of the benefits you get when you set up that LLCS. You can do other strategies, but only if you have the bookkeeping and record keeping done ahead of time. You need to have a good idea of what you're going to have for the year before year end. So right now we're talking in May 2026. And I know for some people, they're still thinking about their 2025 tax returns, but it's the time to also be thinking about your 2026. Get that bookkeeping done. Take that first step to get it done, because otherwise you're going to miss the deductions. Remember that a deduction delayed is usually a deduction missed, and you're just giving money away if you don't do that. Okay, let's go on to number 3, which has to do with something I see that people miss a lot when they first start their business. And by the way, it's not too late. If you've been in business for a couple of years, this is something you can still go ahead and take a deduction for. And it has to do with items that you have contributed to your business when you first started. I know for most of us, when we first started working from home, we kind of did it on a shoestring. I already had a cell phone. I already had a laptop. I had a desk. I had a chair. These are things that I owned personally and bought personally, but I could contribute those to my business. I bet the same is true for you. There's things that you have that you're using right now that you had paid for personally. So the way it works when you get started in your business, these are contributed assets. Make a list of all of those things. By the way, if you have a home office and you can't see it, but I have pictures on the walls, those are contributed assets as well. So is a chair you can't see in the corner. There's things inside here that are items that were contributed to my business. Make a list of what those are, and then come up with the fair market value as of the date. It's not what you paid for, but take a look at Craigslist or Facebook Marketplace. What is the value of those items? Make that list, and then the company pays you back. Now, that might seem kind of a little silly, but remember, we've got the separate bank accounts now, so it can write you a check or make an ACH transfer or whatever. But the fact is that what you want to do is have that trail where even if you have to loan the money to the business so it can pay you back, you now show that there are expenses on the business side, cash to you that is tax-free. You do not pay tax on that money. So this is kind of one of those free little items that people forget about. And if you're still in the first few years of going, or you've started again with a new venture, if you have personal assets that never have been in a business before, never been written off, take advantage of those. Common ones, though, as I mentioned, a cell phone, a laptop, your desk, maybe a file cabinet if you've got that, a printer if you've got that, any of those things that you might have bought personally that now can be part of your business. Pay yourself back because it's money in your pocket and a deduction that saves you taxes. Those are the best of all worlds. Number 4, this is one that is a problem, I think, for a lot of people every year, and it has to do with your car. If you use your car for business, and before you say, oh, I never do, yes, you do. You do use it when you go to the bank. You use it when you go pick up your mail. You use it if you go to the office supply store. I guarantee there are times, if you have a car and you're not just using public transportation of some kind, you do have business miles. Track them. There are apps you can download, or you can just use the old-fashioned pen and paper and keep a note of that. There's 2 things you need. You need to have the total mileage for your car, the total odometer. What I do is take a picture of my odometer at the first of every year or at the end of it. I mean, everybody's got their hangover on New Year's Day or celebrating the day. Make one of your resolutions to go take a picture of your odometer and save it, because then you'll know at the end of the year when you take the next picture how many miles you had in total. Now, if you're keeping track of those business miles, then you'll also know how many miles you had. Now, there's one more piece to keep track of, because we might decide when filing your tax return to use a different method for taking that deduction. And that's the actual expenses that have to do with your vehicle. So if you've got payments that you make, track those. If you have, and that includes lease payments, track those. If you have any repairs, track that. You buy some new tires, you get the oil change, track those expenses. Track your gas, track everything with your vehicle. Now, at the end of the year, when you're doing your taxes, then there's a decision that can be made by your tax professional on whether it's better to take what we call the mileage reimbursement method, which is a cents per mile, or a percentage of your business, of your actual expenses. But if you've tracked those three things, that just made the decision way easier. You need to know your business miles. You need to know your total miles. You did that by taking that picture on New Year's Day. And you need to know what your total actual expenses are. If you don't track the actual expenses, you're probably going to default to the mileage method, and at least you've got those miles. So take a look at how you're going to record that, whether it's going to be just with pen and paper, whether it's an app that you use, but make sure you're tracking the business miles. And by the way, that is the number one problem I have with most of my clients. It's difficult to think about tracking your miles. A little tip here. If you've got multiple cars and you're using, like, let's say you and your spouse have 3 vehicles and you use each one of them at some point for your business, you actually end up with less of a deduction that way than if you just have one vehicle that you use most of the time for business. It's easier and it'll save you on taxes if you focus all of the business miles on one vehicle. It's okay if it still has personal use, and it's okay if occasionally you use another one. But if most of it is on one vehicle, the math works that you get more of a deduction. Just a little hint there. Okay, number 5, as far as mistakes, the wrong entity. I want to take just a second here to talk about a couple of stories. One was, we talk, at Lettuce a lot of times about the tax savings that you get once you set up an LLC that's then elected to be taxed as an S corporation. I think that we need to talk about a couple other things. So I'm going to break ranks here for a minute. When you set up that LLC and S corporation, as long as you're following what are called corporate formalities, you also are going to gain some asset protection. So I want to tell you a story of a friend of mine who's an attorney who gave a talk in San Francisco to a group of brand new business owners. And one of them had a store in San Francisco, it was bricks and mortar, and she spent every dime she had on this very trendy, boutique-y kind of place that was a bricks and mortar that people came in. And he talked to her, he said, that's all great. You've got a great business plan, but you don't have any asset protection. You don't have a structure for this. At least get an LLC going, and you can decide later if you're going to do the S-Corp and everything, but get the LLC. She said, I don't have any money. It's going to take me at least 3 months to make enough money to do this. A month later, he called her in his office, and he was sitting got the phone call. He saw who it was, and he thought, great. She's changed her mind. She's going to set up that LLC now. And she said, I just got notice that I'm getting sued. Somebody came into her store, tripped and fell, and now there's a nuisance claim against her. There's an attorney. And she said, what do I do now? Can I set up that LLC? And his answer was, it's too late. You need to have the entity in place first and be following the corporate formalities. I'm going to tell you a little bit more about that in the next step. By the way, if you make sure that you go to the offer and download the handout that goes along with this, you're going to find checklists for all the things that I'm talking about, because that will then give us a chance to put these things into play that I'm talking about. So let's talk about some of the entities that probably don't work. Maybe because my last name is Kennedy, this one always catches my view, is there's still people walking around saying you need to set up a Dynasty trust just like the Kennedys do. Well, I'm a little different side of the family from the Kennedys, but I can tell you my side of the family doesn't have Dynasty trusts. The fact is that the people misuse the idea of trusts with businesses. Generally speaking, they work great if you're in a very specific tax bracket and wealth bracket. For most of us, the trust is something that's completely different than, you don't want your business running through the trust, generally speaking. Now, if you're in a high wealth, you're worrying about estate tax planning, then yes. But otherwise, for most of us, ignore the idea with the trust. The other one that sometimes surfaces that I hear, and you might have heard it as well, is, oh, if you become a church, then you can write everything off. Now, that is a very specific way to take a write-off. And if you have a nonprofit, absolutely, there are specific tax strategies for that and ways that you keep it true. I mean, that you're ethical with what you're doing. But running your business through a church is not going to work. Good intentions, by the way, don't replace tax law. You might have the best intentions in the world with what you're doing, but you still have to follow what the rules are. Another one that we're seeing back when I was starting my practice, the Nevada C Corporation was the hot thing. Everybody wanted a Nevada corporation because the idea was that you could avoid your state taxes. And that was primarily, because I am from Nevada, was the state to our west, which is California, which has very high taxes. But the fact is it didn't work. Now that seems to have morphed into everybody wants a Wyoming LLC. And Wyoming LLCs work. They've got great tax law or great asset protection law. But for taxes, it really has to do with where you and your business reside. So trying to form in another state isn't going to help you avoid your state tax obligations. If anything, what we're seeing right now in the tax world is the IRS is still there as hard as they've ever been. But watch out, states are getting much more aggressive. They're more agile. They have groups that can focus in a little better, and face it, they're broke. So there are states that are getting very aggressive, and we need to be careful with the state filings that we do to make sure we're in the correct state where we filed, where we set up and we file. It doesn't mean you can't use these other LLCs, just realize that you still need to file taxes in whatever state you're in. Okay, number 6 is having an entity that's in name only. And what I mean by that is somebody that listened maybe to my first story about the lady who set up that boutique in San Francisco and said, okay, fine, I'm going to set up an LLC right now, and then I'll be safe forever. But that's not quite how it works. You need to follow what we call corporate formalities. And they really break down to very specific things. That one is that you need to be careful that you don't commingle your money. So if you're concerned at all about asset protection, which honestly, I think all of us should be, and you've set up your LLC, elected S-Corp treatment, make sure it's in your business is separate from your personal. That's why I mentioned it number 1. There's a lot of tax reasons, but there's also strong asset protection reasons. You need to not commingle your money. Otherwise, it looks like you're doing, the term is alter ego. You have an alter ego business, then it's just you in another pocket. It's still you. That means people can come right at you. That people could be somebody who's suing you, could be the IRS, it could be a state. So we want to make sure you're following those formalities by keeping that money not commingled. Another is that you need to make proper disclosure. So if you are the president of your S corporation and you sign some kind of a contract on behalf of the S corporation, just put your name and title down that you're doing this on behalf of ABC corporation, whatever the name of your company is, as its president, as its manager, as its something. Don't do it just in your own name. I have a story with this. One of my very wealthy clients has now an attorney that's just working for the family. And he came from the litigation world. In the prior life, he actually worked for plaintiffs' attorneys. So he was part of the team that was suing other people. And he told the story of his last client he had just before he went to work for my client, our joint client. There was a problem with the business. They were being sued and they were trying to get to the personal assets. The business itself was pretty protected, but the assets were being held personally. And his job was to find the little chink in the armor. Where was the hole they could get in? And what he found was one email that just had some details about the business and this particular issue, and it was signed just by the person's name. It did not have, like an email, you can have an automatic footer that gives who you are and your title. It didn't have that. But that was enough to break open the case and put him personally liable. As a result, they had a 7-figure settlement. They didn't want to go to trial because they knew that the court would break that. So when you're doing this, make sure you're giving proper notice. Another one is that states require that anything that's corporate has an annual meeting. When an annual meeting is really simple. It's just that you sit down and say, hey, these are the things that happened this year. And you're having a meeting with yourself if you're a solopreneur. It sounds crazy, but it's okay. You can have a mirror and, hey, this way, everybody agrees with you because it's just you and your reflection. Anyway, the point is that you have this meeting and you have the minutes. Now, let's even add a little tax twist to this. You can have that annual meeting somewhere else. So you can determine that your company is going to have your solopreneur is going to have its annual meeting at Lake Tahoe. And guess what? It's a write-off. So you're going to protect your business. You're going to make sure you've got a good journal, if you will, of your business's journey, while you talk about the things you've done. You took on these new clients, you got new credit cards, you opened a new bank account, you started some investments, you got some new technology, whatever it is that you're doing, you've got that memorialized. And if you're ever asked, you can prove, yes, I'm running as a business. And you got a write off. Okay, you got to love those when you get both of those. And you don't need to have 40 minutes, 40 pages of minutes, by the way. I mean, some examples that typically are done, you should have in your very first minutes that you have after you become an S corporation, that you did elect to be treated as an S corp. If you buy equipment, yes, I'm just reading through my list right now. If anything time that you're reimbursing expenses, for example, you personally might have a home office, and probably you do, and the business reimburses you rent on that. So that would be part of those minutes. If you take out a loan for the business, if you bring in a partner, which, by the way, talk to your tax professional before you do. As a solopreneur, you have way better tax write-offs. If you do something with somebody else, maybe consider a joint venture. Don't bring them in as a partner. That's another whole other topic. If you have reimbursements for your expenses, do what's called an accountable plan. Corporations are actually required to have these, and it's really simple. It sounds like it's a big deal, but it's just something that's a written document that says any employee that gets reimbursed for their expenses, and by the way, you're the only employee, has to show that they have receipts for those, and it's their responsibility for providing those in case of an audit, and reimbursements must be made within 60 days. So as long as you show those facts, then you've got an accountable plan. If the IRS or a state ever asks if you've got this, you can show the documentation for that. And finally, the biggest thing is you just respect the entity. Think about that entity as something separate from you. And you need to be protective of it because it will be protective of you, both for extra taxes and in case of lawsuit. Let's go to the final one. And by the way, I'm going to take questions. I know we've gotten a whole bunch of questions here. I'm going to ask Kim for a little bit of help in a second to maybe sort through these on how we can get to the questions. I'm going to do about 10 minutes of questions. And then if I don't get your question, hang on, make sure you go pick up the handout that goes along with this, because when you do, you're going to give me your email address. I promise I won't spam you, and you can quit anytime, but I will send you out the list of questions with answers that were part of this session. Okay, number 7 is simply asking the wrong question. What happens is that I see a lot of people who start their solopreneur career coming from a W-2 job. And as a W-2 employee, you're used to a couple of things. One is somebody else really takes care of your taxes. You don't have to worry about your estimated taxes. You don't have to worry about any of this. It just comes out of your check and somebody else handles it. But at the same time, you've given up a huge benefit, which besides just freedom and the ability to grow your business and determine your future, you also get the ability to take write-offs. As an employee, you don't have a lot of write-offs you can take. But as a business owner, what's deductible? It's like it depends. Just about anything can be, depending on your business. So here's something to think about. Instead of asking the question, what's deductible? Think about where you spend money right now. And then ask the question, how could this be a deduction? And we're not talking about something illegal. It's got to be legal. It has to be an expense that's ordinary and necessary to the production of income. That's straight out of the code. And it's pretty nebulous there. I mean, as a CPA, there's certain things that I can deduct. And then if you're a creator, you're going to have a whole lot of different things that you're going to deduct than I will. That's fine. It's all depending on what our business uses and needs. I have a client who has a business reviewing product. He writes actually marketing scripts for clients and then tracks through social media review of products. Well, as a result, he's either given or buys a lot of different products to test. It just happens to be that he's got a very active family. It happens to be a lot of sports equipment and like mountain climbing and things like that. But it's all deductible because he can prove that it actually is ordinary and necessary to the production of income in his case. So this is the point I'm making about the question. Is it deductible? If you ask somebody, is this deductible? You ask a CPA, they're probably going to say the easy answer, which is no, because you don't have to think beyond that. but ask the question, how could this be deductible? Or in what case could this be deductible? Because you never know. I started off this whole session with that story about the guy who had the bed who he was trying to write off. And I have to say, I never asked him what kind of business he was in that a bed might be deductible. But maybe it could have been. Who knows? I should have asked another question. Okay, with all of that, I'm going to go ahead and take some questions. Kim, what do we do here? I've seen that we've had a lot of questions. Oh, I don't hear you. I think your mic's not on, Kim.
How is that? Better? All right, great. We do. We have a ton of questions, you guys. Thank you. They've been pouring in. And if we go, Diane, into the Q&A section under publish. So as they come in and they're vetted, they go into publish. And then and people are sort of voting on what's rising to the top for them. So it might be good for us just to start at the top. It seems to be the most popular question, which is, when should a solopreneur move to S-Corp? And what are the benefits of doing this?
Oh, great. Great question. There's a couple of ways to approach this. And I know that there's the numbers portion of this is for sure at $100,000 net income. Yeah, you can absolutely just show that this is going to save you significant money. Usually, though, at about 60,000, honestly, you start seeing that. But I'm going to even challenge that a little bit, because when you become an S corporation, a couple of things happen. One is that you have signaled you're serious. It's easy to have an LLC that's taxed as a sole proprietorship. You don't even really have the same record keeping requirements. I mean, when you report your tax return, you don't have to show what we call a balance sheet. You don't have to show your assets and liabilities. But as an S corporation, you do. Absolutely, it will be easier for you to get bank loans when you get an established S corporation. So the sooner the better if you're serious about that. If you know this isn't, I'm going to try this and see if it works for me, and if not, I'm going to close it down. Maybe that's not the right time. But if you've got the mindset, I'm in this, maybe the S corporation right at the jump is the better answer. It gives you that that reputation, if you will. Your bank will take you more seriously. I guarantee this is going to happen. They will realize that, hey, we're serious. If you go somewhere and you mention that you're with this company, even if it's your own, you will be recognized as someone who's serious. So it depends on what your plan is, but take it all into account. Just for the numbers, 100,000 for sure, net 60,000 probably, and then maybe even just at the beginning, you get started with that. Great question. Okay, I bought a domain name, built a website, and bought some digital tools to build the website. It's been a couple of years. Can I still add them to contributed asset? Yes. But what we need to do is go back and figure out what the fair market value was at that point. I'm actually kind of sad that you didn't take the write-off right away for the domain name, because that would have been an expense right out of your pocket. And the fair market value is whatever you paid for that. But yeah, and for you, what I would challenge is, if that's what you're doing, I mean, I'm certain you contributed a laptop right at the beginning. Even if you upgraded it later, you would contributed something, and a cell phone, and I don't know, maybe some digital video equipment. I'm not sure exactly where you're going with that, but there's probably things you contributed right away. Think about that. And yes, the company should reimburse you for that. Let's see. For somebody just starting out 3 months in, how important is it to set up an LLCs versus as a sole proprietorship? When does the book of business, when does the distinction become more important? As far as for your business, without knowing your customers, I don't know when that would become more important, but you brought up a great point there. People are more, you're going to feel more solid if you have initials behind the business name versus, yeah, it's just my social security number and it's just me. When you do your W-9, it feels less certain. And then the other part of this, lettuce, typically lettuce is built around the numbers. It's a company that wants to look at, hey, we're going to show you how much money you're going to save, which is absolutely true when you start showing profit. I honestly have seen the bad side of what happens when you don't have the asset protection right away. And so I get nervous if somebody doesn't have an LLC. Even if they haven't elected S-Corp yet, they will, by the way. But if they haven't done it yet, just having the LLC, I've seen too many of the horror stories of what happens if you don't have that. So that's my own personal experience that's speaking there. Okay, next one. I know that they're changing order a little bit here. If some banks, it seems banks require a personal address in order to open an account. Yeah, due to the know your customer law. Is there a risk to commingling if the business bank account address is the same as my personal address? No, there is no, that isn't an issue at all. This is a for what it's worth. I personally have a home office as well. Although the bank knows my home office, I ask them to always use my business address, which is a separate address, just because I don't really want everybody knowing publicly where I live. That's just kind of like, maybe that's me and my paranoia, but yes, that you can have the same address for your business and personal, but keep those accounts separate and keep the streams separate. If it's a personal expense and personal income goes into your personal account, business income and business expense goes into your business account. And go ahead, Kim. I don't hear you. I don't think your mic is on.
Oh my gosh, again. Okay. Before you do another question, I was just going to say there's a few people that continue to ask for the handout that are having a hard time. So I just wanted to explain it quickly to folks so that they can get in there, because I know it's important too that they download. Guys, go to the handout section, which is right next to the Q&A button up top. And then you'll see below it, there's two options. There's offers or there's handouts. You actually want to click on offers. And the first one here you'll see is a speaker offer a free guide. That is the guide from Diane. And if you click on that, you should have no problem getting access to it. So hopefully that clears up a few questions in one. Sorry to interrupt.
Oh no, I'm really glad you mentioned that, because the things talked about, and I went through fairly quickly. There is a checklist that goes along with those, and like these are the most important things. These are the things that could put you at risk. So I think it's important to have it in your hands, as well as it gives you a chance to get the questions answered. I'm going to talk for about 4 more minutes, and then I'm turning it over to Kim, who's got some wrap up items to cover. So a question here, and this is a good one. What if you've commingled and now you want to fix it? What happens? Are you forever at risk? So that's a great question. What I would do is fix it as soon as possible, get this set up, and you do the LLC S corporation, and maybe your first set of minutes absolutely talks about this. That initially these were done. This is how we determined how to separate the business and the personal, and this is the procedure we followed. Put it in your minutes. Now, the reason that I think that's important to do is if somebody ever comes back and tries to sue you, then you've got, hey, this is the procedure we followed. A lot of times the law in general, and tax law particularly, rewards people who have a procedure and they follow it. Kind of a saying is, you don't have to be perfect. You just have to be consistent. And so that you're showing process that you're going through this. Just as a comment though, and remember, I'm a CPA, not a lawyer. You do not have a statute of limitations that runs forever. So if you have made a mistake in the past, this is not going to haunt you until your deathbed. You don't need to worry. It depends on the state you're in, how long that statute runs, depends on what exactly was involved and why they're suing you. But you can fix it. From this day forward, we're doing better, and we acknowledge what happens, and this is how we took care of it with our internal controls. And then at some point it expires depending on the state you're in. Okay, let's see. I can do one more question. I'm currently an LLC and I want to move to an S corporation. If I plan on staying a solo entrepreneur, is this still a smart move? It's absolutely a smart move. So what you do as an LLC is you're going to make an election to be taxed as an S corporation. It's interesting. An LLC doesn't really have a tax return. There is no such thing. I call it a tax chameleon because it can be anything. You can have, if it does nothing, it's going to be a sole proprietorship. If the LLC elects to be taxed as an S corporation, it's an S corporation. If it elects to be taxed as a C corporation, which I don't recommend, it can be a C corporation. So that LLC can elect to be taxed as an S corporation. And then, yes, absolutely, the solopreneur, that's a great structure for a lot of reasons. The tax savings is one that, especially after you make $100,000 or more, we're talking real money here, folks. And if you're looking at it, tax savings is maybe the best kind of money you can make because you never have to pay taxes on it. So why not save another $14,000, $15,000 in money and put it in your pocket? It's tax free. So they can save you at that. But even at 60,000, we start seeing benefits from having the S corporation over that sole proprietorship. And I made that statement earlier about how being a solopreneur is actually a lot better for you tax wise than bringing in a partner and having another partner in your S corporation. What happens is with that is that when you have a partner, you have to always be looking at the same benefits for both of you. For example, you want a medical insurance plan. Your partner's like, yeah, I don't care if I have that or not. My wife works, got a great plan. I don't care. But I really want a really strong retirement plan. And you're like, I don't care. I just want to make sure that I'm covered with good insurance. So you end up neither one of you getting exactly what you want, but because you're partners in this business, you're both shareholders, you can't just pick and choose and have deductible the items. In order to be deductible, a medical insurance plan, the retirement plan, et cetera, has to be what we call non-discriminatory. In other words, everybody who can qualify, it's a full-time employee like your partner, gets the same thing. And because neither of you want the same thing, nobody gets what they want. So just think about it before you bring in a partner. Is there another way to achieve that? And thank you so much for these questions. I think we can continue to get those. We're going to capture them at the end of the session, and then I'll be answering those. Make sure you get the handout. Go to handout and download the offer. And I'm turning it over to Kim for some final announcements. Thank you.
All right. Diane, thank you so much. Everybody give Diane a hand in the chat. That was hugely informative, and you guys have been a great audience. The questions have been just flowing in, which we'd love to see. So thank you so much. Just before we let you go, I know there's another session starting in just 4 minutes, so we'll give everybody a little bit of time if they can before they run to their next one. I wanted to make a quick plug here for Let Us for the solo sessions that are happening in the next couple weeks coming off the back of this summit. They're a little different than the summit. These are going to be small group Zoom conversations. So they're capped, they're intimate, they're real. You'll be in a room with a few other attendees and a community leader for a genuine hot seat conversation. Cameras are on, everyone can talk. It's a dialogue. You bring what you're working through, share your expertise, get input. And it's a way to just continue the learning and the journey. So also under handouts in offers, there is a link directly to register to be either in the hot seat with the question you have or an attendee at the solo session. So we loved having you here today. We hope we continue to see you at Let Us events in the road. And Diane, thank you so much for today and for your commitment for getting back to everybody with all these questions. That's amazing.
Thank you, everybody.
Okay. Bye, everybody.